What's up, you guys? Hope you're doing well. My name's Jeremy Verbit, and now that we're a few episodes into the channel, I've been meaning to update my YouTube studio with a new coat of paint. But I've been waffling on the idea because painting is so tedious and so much work, but now is the time. So without further ado, let's paint it. In 3, 2, 1... That's better. But wait, something's missing. There we go. Ow, my finger hurts. And now I've got a haircut. I think we're ready to go. Today, I'd like to talk about how taxes work. Many people spend around the same amount on taxes as they do on their housing. But they don't realize it because those taxes are being taken out of their paycheck before the money ever hits their bank account. In 2019, the average American contributed 30% of their income towards taxes, Medicare, and Social Security. And according to the Business Insider, the standard measure of housing affordability is 30% of gross income. While we normally talk about after-tax income or net income when we deal with calculations like savings rate, which as you'll see in the link to the video right above me here is how I'm retiring by age 35, reducing your taxes is a key component to increasing your net income and therefore your savings rate. And there are a lot of levers you can pull to reduce your taxes and potentially even earn over $100,000 per year while paying $0 in taxes. But to understand how to control these levers, we must first understand how taxes work. First, there's income taxes. A lot of people see these tax brackets and fear that a raise that just barely puts them into the next tax bracket will cost them more money, thinking their entire income will be taxed at that higher rate. I've seen this fear be especially true of single filers making close to $40,000 or married filers making close to $80,000 because these taxpayers are on the borderline of jumping from a 12% tax bracket to a 22% tax bracket, which nearly doubles their tax bracket. But I'm happy to say this is not how taxes work. Let's say you're making $40,525, the top of the 12% tax bracket, and you get a small raise and start making $41,000 per year. The tax bracket system is a progressive system, which means you pay 10% on the first $9,950 you earn, then 12% on the next $30,574 you earn, then 22% on the next $475 you earn. If you made $40,525 per year, you would only pay 10% times $9,950 plus 12% times $30,574 for a total of $4,663. But now that you make $41,000, you only pay an additional 24% times $475 or $114 more, for a total of $4,777. Paying $114 more while making $475 more is a trade-off I'd take every time. But there's also 3 ways to reduce your taxes: tax deductions, tax credits, and adjustments to income. Tax deductions reduce the income that you need to pay taxes on. So in our example of earning $41,000 income, let's imagine I have a means to take a tax deduction of $475. In this case, my taxable income would be reduced by $475, bringing my taxable income back to $40,525. We already calculated taxes on that income, and it was 24% times $475, or $114 cheaper than what we paid at $41,000. Tax deductions lower income that you're taxed on, and therefore lower the tax you owe by the top tax bracket percentage, also called marginal tax rate, that you would pay. Tax credits, on the other hand, are better. Tax credits don't lower your taxable income. So if I have a means to take a tax credit of $475, I'm not reducing my taxes by $114. Instead, I'm reducing my taxes by the full $475. Adjustments to income are similar to tax deductions, but happen before taking into account tax deductions and aren't grouped into them. And I'll explain why that's important after we go over what adjustments to income are. Adjustments to income are primarily made through traditional 401k, 403b, 457, and IRA contributions. They aren't made through contributions to any Roth accounts, as those accounts don't reduce your income today, only in the future. I'll use the traditional 401k for our examples. Contributions to traditional 401ks essentially tell the IRS, pretend I didn't make any of this money, let me keep it in this traditional 401k account until I decide to take it out. Once I take it out, you can tax me then, but not before then. Contributions to traditional 401ks adjust your income downward like you didn't earn it in the first place. So if I made $41,000, but I contributed $475 to a traditional 401k, the IRS won't tax me on that $475, and I'll again have saved $114. So adjustments to income and tax deductions both reduce your taxable income. So why doesn't the IRS just call 401k contributions a tax deduction? Because there's other deductions they don't want your 401k contributions counting against. One of these is the standard tax deduction. When you file your taxes, you can pick to itemize available tax deductions like charitable contributions, state and local taxes, and mortgage interest. Or you can pick to just go with a standard tax deduction of $14,550 for single filers and $25,100 for married filers. Obviously, it'll benefit you to itemize if you can itemize more deductions than the standard deduction, but this isn't very common given how high the standard deduction is. Now let's revisit our example of earning $41,000. You take an adjustment of income of $475 with a traditional 401k contribution that brings your adjusted gross income down to $40,525. You then take a standard deduction of $12,550 to reduce your taxable income down to $27,975. This causes you to owe 10% times $9,950 plus 12% times the difference of $27,975 minus $9,950 for a total of $3,158. The adjustment to income saves you $114, and the standard deduction saves you $1,505. In addition to income taxes, you also pay Social Security and Medicare taxes, which are more straightforward. For Social Security, you pay 6.2% of your income up to $142,800 of your income, at which point you no longer pay any more towards Social Security for the rest of the year. For Medicare, you pay 1.45% of your income up to $200,000 of income. After that, you pay 2.35% of the remainder of your income. There's not much you can do to avoid these taxes, as they're calculated against your gross income, and no adjustments to income or tax deductions can reduce them. Social Security and Medicare are often referred to together as FICA, for Federal Insurance Contributions Act, which established these safety nets for the elderly and sick. To summarize income taxes, tax brackets are a progressive system. Your gross income can be reduced for tax purposes via adjustments to income like traditional 401k contributions or tax deductions like the standard deduction. Tax credits reduce your taxes, the full amount of the credit. FICA taxes are a progressive system. 7.65% for the first $142,800 of income, 1.45% for the next income up to $200,000, and 2.35% for any income after that. There is another type of tax known as capital gains taxes, and these are what we'll use to earn six figures but pay zero taxes. A capital gain occurs when you sell an asset for more than you paid for it, and this is common for appreciating assets like stocks and real estate. The capital gain is only the amount the asset appreciated over the amount you bought it for. The amount you bought it for is known as its cost basis. So if you buy a share of stock for $100 and it appreciates to $110 and then you sell it, your cost basis is $100 and your capital gain is $10 and you'll owe taxes on that $10. If you sold it within a year after you bought it, it's known as a short-term capital gain, and it happens that the IRS taxes those exactly like income. The same goes with any dividends that a stock puts off. But if you sold it more than a year after you bought it, it's known as a long-term capital gain, and the IRS gives it favorable tax treatment. Like short-term capital gains, that $10 long-term capital gain counts towards your yearly income, and in doing so, could put you in a higher tax bracket. But long-term capital gains, instead of being subject to income taxes, is subject to long-term capital gains taxes, which look like this. Single filers with incomes up to $40,400 pay 0% tax on capital gains. Incomes above that, up to $445,850, pay 15% on those capital gains. And any incomes over $445,850 pay 20% tax on their capital gains. For married filers, incomes up to $80,800 pay 0% tax on capital gains. Incomes above that, up to $501,600, pay 15% tax on capital gains. And incomes over $501,600 pay 20% on capital gains. So if you're married, you can earn $64,100. Have both you and your spouse contribute $19,500 each to your traditional 401ks. Take a standard deduction of $25,100 and you will be taxed on $0 of income. Then, you can still sell enough stocks to generate a capital gain of $80,800, putting you at the top of the 0% capital gains tax bracket, and you've earned $144,900 for the year without paying any tax outside the FICA taxes and perhaps state and local taxes. The trick is selling the right stock shares to trigger capital gains when you want them. You don't want capital gains in your high earning years since your higher income could bump you into the 15 to 20% capital gains tax bracket. But if you retire early and don't earn a lot of money, you're okay with capital gains since when you trigger them, they will be taxed at 0%. You can even sell the stock in a lower income year to trigger a capital gain and immediately buy the stock right back again. This triggers a capital gain which you pay 0% taxes on, then sets your cost basis back up to the current price such that when you sell the stock in the future, the capital gain you trigger at that point would be much smaller. This is called tax gain harvesting. To control the amount of your capital gains, you can pick what specific shares you want to sell, the shares you bought at a specific price at a specific point in time. Now, what about during your high income years? You prefer not to sell your appreciated stock and trigger capital gains that you'll pay 15 to 20% taxes on. But there is a loophole that's the opposite of tax gain harvesting, and it's called, well, tax loss harvesting. If you sell stocks at a loss, selling them for less than you bought them for, the amount you lost can be used to offset your capital gains. Any unused capital losses can roll over year after year until you have capital gains to offset. So pretty much whenever you can sell at a loss, you want to do so. But the downside is that unlike tax gain harvesting, the IRS doesn't let you sell a stock at a loss to harvest the loss, then buy the stock back right away. They have what's known as the wash sale rule, which doesn't allow you to buy back a substantially similar stock within 30 days of selling at a loss. What substantially similar means is very blurry and arbitrary. But in general, if it isn't the exact same stock or an index fund that follows the exact same index as what you sold, it's considered safe. So there is concern about buying high and selling low when doing this. The stock you sold might have been at its low and ready for a bounce back. But let's say you sell my favorite index fund, VTSAX, which is about 70% large cap, and then immediately buy VFIAX, which follows the S&P 500. You've basically just locked in a tax loss harvest while enjoying any upside the market has to bring thereafter. Furthermore, tax loss harvesting lets you count up to $3,000 per year of tax loss as an adjustment to income, lowering your higher income taxes. Now you see how long-term capital gains have favorable tax treatment that can allow you to earn a lot of income with no taxes. But capital gains only work for taxable investment accounts. Retirement accounts are generally preferred over taxable accounts. That is, unless you're using the taxable account like an emergency fund like we discussed in the video above. So you likely won't have substantial funds in a taxable account unless you're already maxing out your retirement contributions. So let's go over exactly how retirement accounts save on taxes. Earlier we said traditional retirement accounts reduce your income today, but you pay taxes on it when you take the money out. Roth retirement accounts are the exact opposite. You pay income taxes on it today, but not when you take the money out. Traditional account or Roth account, you pay income taxes on the money regardless. And if your marginal tax rate is the same now as it will be in retirement, you will end up with exactly the same amount of money whether you used a traditional account or a Roth account. So how do retirement accounts save you on taxes? It's capital gains taxes. And if you have high turnover, which is selling and buying within the account, those capital gains compounded, also called tax drag, can cost you a significant amount of what you otherwise would have made. The optimal plan for early retirees is to use traditional retirement accounts to avoid paying taxes on income going into the account. Then in retirement, use a standard deduction to again avoid paying taxes on that income coming out of the account. You just avoided paying income tax on that money whatsoever. That's why I prefer traditional 401ks over Roth 401ks. They provide a means to pay 0% taxes on a portion of your income. I still prefer Roth IRAs over traditional IRAs just because you can access the contributions to Roth IRAs anytime, penalty and tax-free at any age. That's all for today. Love you guys. See you next time. Be sure to smash that like button, subscribe to see my next video, and comment down below, and I'll be sure to respond.